I'm very pleased to introduce our next speaker. His name is Howard Chow. He is a member of the advisory board for the Berkeley China Initiative. He's also a partner and head of the Asia practice at O'Melveny & Myers, where he's practiced for the last 25 years. He's responsible for establishing O'Melveny's China offices and was stationed in its Shanghai office for 7 years. He's currently engaged in a general corporate practice with an emphasis on cross-border and Asia matters and is a recognized authority on China. He earned his law degree here at UC Berkeley, where he was also a member of the California Law Review. Please welcome Howard Chow.
Thank you very much, Camille. It's great to be back at Berkeley. I spent 2 years in IHouse, so I'm an old IHouser. And it's also great to be back under the aegis of BCI. Berkeley is a great institution that I'm very pleased to make a contribution to, and I think it's high time that Berkeley steps into basically the void when it comes to the Bay Area studies of China, and especially in the business context, where I think there's not enough going on in programming in this area. So I'm terribly pleased to be part of this. I'm really the warm-up act for the main band that's going to be playing later here in about half an hour. I'm going to try to set the scene for the later discussion on private equity investing in China. Let me just give you my perspective on why I'm involved in this sector. As you learned earlier, I've been practicing law for 25 years. And lived in China for many years. I'm still commuting back and forth the last 4 years, having moved back to Silicon Valley about 4 years ago. And I head up our Asia practice, where we have about 85 professionals in Greater China, and we have about another 25 professionals in Tokyo. So we focus on the 2 biggest markets in Asia. And a large part of what we do is private equity and venture investing in China. And I'm on the airplane a lot. I just got back last Friday from China, and as you can see, I had a little accident yesterday bicycling, and one of the problems with this airplane thing is you get jet lag. So I don't recommend a lot of bicycling with a lot of jet lag at the same time. But so that's the explanation for why my hands look this way. The other takeaway I took from this little experience is that, the reason this PowerPoint is not filled out is because my typing was not really great this weekend. I just realized how much we rely upon our fingertips these days as modern technocrats. But in any case, so I'm going to sort of talk at you today instead of PowerPoint at you today, and give a sort of an overview of the private equity landscape and trends in China today. And there are a lot of trends and a lot of changes. I would say in the last 2 or 3 years, the private equity landscape in China just completely changed. You heard in the morning about venture, and so I'm not going to spend a lot of time on venture. Obviously, that's really part of private equity, but I'm going to spend more time on the larger scale transactions that we're seeing in China, and we see a lot of transactions in China now. I did a head count recently about how many we as a firm, just ourselves, closed last year, and my count was 40 closed private equity and venture transactions in China last year, 2005. So it's a much bigger number than what we've seen in prior years. And even though as a percentage of the total FDI investment flows into China, it's a minuscule percentage. $60 billion of that. What is the number? I mean, to say $2 billion last year, if whatever the number is, it's a small percentage, but it is way up, and it's also disproportionate in its impact. And I'm going to talk about that in a minute. But so what are some of the big trends that we're seeing in private equity? And this is one of the great things, by the way, about my job, is I get to see these so-called mega trends in our practice and what our clients are doing. As a law firm, you get to act a little bit as a barometer of what the business community is doing. So What do we see? Well, first of all, we're seeing larger private equity firms of all asset classes coming to China. Not just the venture community, but many sort of the very top-tier buyout firms, the real estate funds, the distressed players, the hedge funds, virtually every asset class is now coming into China. You know, we have a new office space we moved into recently in Hong Kong at this new tower called the AIG Tower, which is a beautiful new tower in Central. Well, I looked at the roster in this brand new building, and you know, KK&R is there now, Oak Tree is there now. There's quite a few, you know, names that you would recognize as being very significant players in the United States now setting up in China. This is only in the last few months. And so that is one clear trend, is the move by very, very large mainstream private equity players and other funds into China, Greater China. And also, it's all nationalities, too, by the way. I mean, it's private equity investing in China is a little bit like the UN of investing. You know, it's not just U.S. investors, it's Europeans, it's Japanese, it's Singaporeans, it's Greater China money, money from many, many different sources. And so we often have to deal with multiple nationalities in these deals. It can be quite interesting. And let me just talk a little bit about these other asset categories before I talk more about buyout, because I'm going to talk mostly about buyout. But let me just touch on real estate and distressed a little bit, because we're seeing a lot of that as well. In the last 12 months, we have seen a tremendous flow of institutional real estate money coming into China. And it's the names that you would recognize as household names in the big ticket real estate institutional community in the United States. And they're coming to China to buy both distressed real estate properties, high quality and performing real estate properties, and trying to make debt-like investments in real estate. And why is that? Well, I mean, you know, you look at the skyline in China, and I guess it's pretty clear why. I mean, there are lots of different real estate assets in China. It's one of the few areas in China that has not been really picked over. Many of the properties are very high quality. Many of the properties are also distressed. And so the people are just seeing a tremendous amount of assets that they can go after. And meanwhile, they want to take advantage of the macroeconomic boom in China, the fact that there is a huge construction boom. And, you know, surprisingly, it's not just the main top first-tier cities. A lot of people are moving into the second-tier cities, and they're seeing opportunities there that are clearly not distressed situations. They're seeing good value situations in real estate in China. Another sector I would note is the distressed sector. Many distressed big-ticket investors are coming into China. Even though the NPL market has so far been a disappointment in terms of generating a good deal flow in China, I would say that interestingly, there are a lot of other distressed situations in China that we're seeing that are of interest. These would include, again, as I mentioned, real estate, but also distressed company situations. Maybe partly the fallout from the state-owned sector privatization process, or whatever other reason. But I think there are lots of distressed opportunities in China, despite the booming economy. I mean, it's kind of a contradiction. You might think that there'd be a lot of distressed opportunities when the market is, the economy is booming as well as it is. But China's economy is a complicated place. So I would put a note on that. By the way, I would note also that the hedge funds are in China in force. We see a lot of activity by the hedge funds behaving as venture funds, behaving as buyout funds, behaving as growth equity funds, behaving as real estate funds. They're in China, and they're quietly very active in China. As you can see, it's a very diverse and complicated picture. Now, why all of this activity? Well, you know, the reasons are of course diverse. But I suppose one of the reasons is that there is such a push by the corporates into China. if the boardroom in the Fortune 500 or 1,000 companies are all dictating that their companies should come into China, then you know that there's somebody ready to buy your company when you want to get out of China. I think the part of it has to do with just the pressure of people wanting to buy into China. And I think, of course, the private equity funds are looking at the macro picture. They're looking at the growth story. They're looking at the demographics. They're looking at a lot of the things you heard about this morning from the analysts from the asset allocation specialist from Morgan Stanley. But all of that is figuring into the picture. Whatever reason, we're seeing the larger size funds come into China, and they're looking for larger deals. Obviously, they're larger funds, so they have to have larger deals. They have to meet certain minimum size requirements for their deals, and so the deal size is definitely going up. Now, big for China is still not the same thing as big for the United States. It's still unusual for you to see a deal more than $200–300 million in size in China. I think it's fairly common nowadays to see a deal more than $50 million in size. I'm talking about just the equity investment piece. But we're seeing a significant number of deals over $100 million ongoing in our office right now in many different sectors, and I'll talk about sectors in a moment. Where are the sources of the deals in terms of the sellers of companies? Well, it's interesting because the sources are diverse. China is a place that has opened up for more than 20 years now, and it's had a chance to create a large asset base domestically, whether it's from the SOE sector, which has been privatizing rapidly. As someone mentioned earlier, when I first started going to China, the official statistic was that the SOEs took up 80% of the industrial landscape. Well, today, I think the official number is less than 40%. And so in that space of 20 years or so, half of that sector has been privatized one way or the other. And so that's a sector that has generated a lot of investment opportunities, whether SOEs themselves or companies that have been privatized and are now at least quasi-private or private. And there are also a lot of homegrown private companies in China, companies that have been started by entrepreneurs, or entrepreneurs have taken over small amounts of state-owned assets and built them up into a huge company, or just completely from scratch in the countryside. There are also a lot of mixed ownership companies that had some state ownership, some private ownership, maybe some foreign ownership, and then finally, of course, there's the foreign-owned or foreign-invested sector. There are a lot of foreign companies that have invested in China and who are interested in spinning off their assets. There are, of course, a lot of private equity and venture investment in China as well, which have generated buying opportunities. So there's a lot of sources of assets in China today. Now, I would say also that what we're seeing, because of this need for size, is that we're seeing a lot more in the way of control deals coming into China. And it used to be that it was harder to get control in China, and a lot of the deals we saw in early days in the mid to later 90s, there was less control, and frankly, there was a lot of suffering because of that lack of control. Today, I think the larger buyout funds are coming to China, and they're expecting more and more control. And I guess one of the issues I'd like to explore with our panel is the means and realities of control in China. And what we're seeing too are deals which are attempting to structure themselves like true buyouts in the United States. I say attempting because it's very hard. And that's another subject I'd like to explore later this afternoon is what are the challenges and difficulties of actually doing a real buyout deal in China. Let me just talk a little bit about an emerging trend, which I think is very interesting, because I think you're going to see a lot more of it in the newspapers, and you're already seeing it now, in fact. And that is, as you probably know, there are a lot of shares in China a lot of equity in China that's tied up in the form of legal person shares. As you know, there are 1,400 listed companies on the A-share market in China, and most of their shares, the majority of their shares, are held by corporates and state-owned entities that are in the form of so-called legal person shares, which means that they're not tradable on the public markets in China, as distinguished from the minority that are tradable on the exchanges. And that has caused a very large overhang in the domestic stock markets in China, and the stock markets have over the years continually anticipated this overhang as a depressing price force on the domestic markets, and so that's one of the explanations you're given for why the A-share market has performed so poorly. Well, as you probably have read, the A-share market is being reformed by the government because the government says let's get out of this system where you have this huge market overhang. Let's reform the A-share market. And so in the last year, the government has started a pilot program to so-called the G-share reform, which means that they've chosen about 120 companies to convert all of their legal person shares into tradable A-shares. And the process by which that happens is complicated, but essentially it involves requiring a shareholder approval of a plan whereby the legal person shareholders have to compensate either by shares or cash the public shareholders in order to for their effective price depression that will be caused by the sudden tradability of these legal person shares. And so this program is ongoing, but the end point of this, announced by the CSRC, which is the Chinese SEC, is that they say by the end of this year, maybe later, that all of these companies, all of the A-share companies, should be going through this reform. I mean, to me, it's a little bit hard to imagine this is all going to happen by the end of this year. But, but still, the goal is lofty, the goal is laudable, and that is that, at the end of this process, which, by the way, is preventing any share issuances from happening in China right now, at the end of this process, you're going to have, as Jack alluded to earlier this morning, hopefully a much more real and functioning capital market in China, domestic capital market that people can actually go public on and can raise capital on and can trade their shares on and can exit on. And so that's a huge sea change in the domestic landscape of China. I mean, compare this with India, where, India, the domestic capital markets are the first port of call of any domestic Indian company that wants to go public. I mean, in China, the first port of call is Hong Kong or NASDAQ, right? And so this is potentially a huge change. Anyway, so the private equity investors are looking at this and saying, this is a potential real opportunity. Let's buy some legal person shares before this reform happens. And so we're seeing a lot of people trying to get into legal person shares today, hoping in a way to beat this market change, get in when the shares are illiquid and at a low price or low valuation, and then hopefully in a year or two when the dust has settled, now you suddenly presto have some tradable shares. So that's one big thing that's happening. The other big thing that's happening is that the Chinese government, the CSRC, has passed in the last month a new regulation that says, in addition to that, you're also going to be permitted, once the reform has finished with respect to a particular company, to be a strategic investor in A-shares, because up to now A-shares are off limits, basically, to foreign investors. Well, if you can buy into A-shares, whether through a new issuance or through purchases of existing shares, then that means a whole new category of foreign investors are going to be allowed on the A-share market, the so-called strategic investors. And the definition of strategic investor in these regulations has to do with your total assets under management. But if you are permitted to do this, then suddenly the A-share market is becoming internationalized. It's becoming a place where foreign capital can play much more freely than previously. Previously, there was this regime called the QFII regime, the Qualified Foreign Institutional Investor regime, which was very limited. But this is going to open it up more. And I have a feeling that if this really starts to happen, then the private equity investors, the foreign strategic investors, when they become active participants in the A-share market, are going to really drive the A-share market. They're going to want to make sure that the A-share market works, functions, and allows them to exit. Because after all, how do you get rid of and monetize your A-shares? You're certainly not going to take them to Hong Kong. You're going to monetize them in China. and so therefore that market has to work for you. So I think maybe Jack's dream of a real functioning domestic Chinese market may happen sooner than we expect. Who knows? Maybe longer than we expect. Who knows? I like to cover my bets here. So anyway, I think those are all very interesting trends, but we clearly see a lot of A-share company-related deals. Not just, by the way, only A-share purchases themselves or legal person shares, but also investments up and around A-share companies. For example, we're seeing deals where companies buy into the holding company of an A-share company. You know, very often A-share companies are held by a state-owned enterprise or group company that owns a majority. So you buy into that company as a strategy. There may be peculiar reasons why that would be an easier transaction to do. Or you may actually buy assets from an A-share company. You know, A-share companies often have very good assets. They may be financially stressed. They may need cash. Management may see this as a way to get on board with a private equity-backed group or company and take some equity themselves, whereas if before they were kind of stuck in an A-share company where they didn't have any equity. You know, there are a lot of scenarios why this might happen, and so we're seeing all those different kinds of deals happening in China right now. Well, I'm going to leave some fodder for the panel, so I'm going to jump ahead here. Let me just talk a little bit about what's hot, what sectors are hot, some of the problem issues and exits. And I think I only have about 2 minutes to do that. 5 minutes? What's hot in China? I mean, people always ask that question. I think it's a harder and harder question to answer because China's hot, right? So what is not hot in China? But I would pick out a few sectors. I mean, everybody has obviously seen the fact that financial institutions are hot in China. You know, everybody's trying to get a piece of a financial institution in China. There are not a lot of them, so if you get a piece of one, the odds are you might, you know, do okay. Obviously, that's not the only analysis that goes into these deals, but there have been a lot of minority investments in financial institutions, and that's a hot sector. There is a lot of interest in new media. The media sector in China is one which is highly regulated, as you can imagine, but there are still ways to invest in and around the edges of media which is not regulated. Even in the regulated areas, there are some certain types of investments that are easier to do than others. And you know, the fact that people this morning were talking about content means that, you know, you ought to be able to invest at least in some kinds of media companies. The private equity, the buyout groups, of course, they're interested in steady cash flows and well-established businesses, and so, not surprisingly, we're seeing a lot of investments in traditional businesses and industries. So basically boring manufacturing companies that you know, churn out good profits and cash flows are a lot of what we're seeing. There's a very strong interest in retail. If you look at the PEs of retail companies in the Hong Kong Stock Exchange, they look like internet companies in the United States. There's a huge interest in that sector because people view that as one that will benefit from the upside in the demographics of China. That's one we're seeing a lot of. Real estate I mentioned earlier, and then distressed I mentioned earlier. So that's just a quick glimpse of what we're seeing as hot. I'm not going to be able to get through all of this. Maybe what I'll do is I'll save the problems for later for the panel, but just talk a little bit about exits. This morning you heard a lot from the VC panel about NASDAQ exits and why they may or may not be the right solutions. One panelist was of the view that NASDAQ is becoming more difficult because of Starbucks, and you know, there are people looking at Tokyo and maybe London, and we're seeing that actually. We're working on 2 Tokyo Stock Exchange listings for Chinese companies. We're working on several London as well. But you know, it's interesting to see. I mean, we think that the NASDAQ exit is still going to be very strong. Last year there were a total of 7 NASDAQ Chinese listings. one in the New York Stock Exchange, all venture-backed, no SOEs, right? The year before that, there were 11, okay? And this year, I think it's going to be at least 18 or 20. I mean, just based upon what we're seeing in the pipeline. So, I mean, that's maybe an optimistic prediction, but I see NASDAQ as doing very well this year. NYSE is not doing as well because the SOEs have all gone away from the United States. The bigger deals have not been coming to the United States. They've all gone to Hong Kong to list. And so Hong Kong is becoming the dominant exit and listing location for Chinese companies for all sectors other than venture-backed technology companies. You know, Hong Kong, there were 6 billion plus IPOs in the last 12 months of Chinese companies. And if you look at the list of the top 10 IPOs worldwide in 2005, you'll find that I think either 4 out of them or so were Hong Kong, and one, number 10, was in the United States. So, you know, Hong Kong is actually becoming a very significant player in international capital markets, just as Chinese companies are becoming a very significant source of IPOs globally. And those two facts are not unconnected. But I would make one final observation before we break for the panel, and that is that, interestingly, the venture investors are going to be very focused on NASDAQ precisely because their companies, if they're reached a certain size, are naturally going to go to the NASDAQ. But if you look at the private equity, larger private equity fund investors, the ones that are doing buyouts or larger industrial or other non-tech investments in China, they're uniformly looking at the Hong Kong Stock Exchange for their exits. They don't see the NASDAQ or the New York Stock Exchange as the right place for their companies because the following is not going to be good, because they're not going to get the kind of understanding of their company that the Hong Kong Stock Exchange is going to give them. Whatever reason, there may be lots of other reasons as well, but that's the clear trend. I'm sure there'll be exceptions to that, but that seems to be the clear trend. So it'd be interesting to hear what our panelists say this afternoon about this issue, but my guess is you'll find that if they're talking about a listing, they're probably mostly talking about Hong Kong. So anyway, that's a very quick survey of the private equity landscape of China. Do you want to, I'm happy to answer any quick questions if you like, or we can go straight to the panel, or what would you like? Save with the panel? Okay.
Thank you. So we'd ask the panelists to come up. We're going to have just a minute or two break while we get set up here, and then come right back for the panel discussion on private equity investing.
Come here. Nice job. Thank you.